Hi guys, welcome back. Cybersecurity companies like Cloudflare or Palo Alto Network rank pretty high on the wish lists of many investors. And this makes perfect sense, because the overall cybersecurity market is a quickly growing one. Grand View Research expects a market growth of 12.9%, and Forgett Business Insights goes even higher with the forecast of 14.3% growth until 2032. This is pretty insane growth that should also stay this high for many years to come. But even though I usually focus on individual stocks for my investments, in this case I find it hard to choose any single one company. And in this video I will explain why this is and why I chose to invest in a cybersecurity ETF instead. I'll also show you how you can find a good specialty ETF, including my concrete process and my selection criteria. My name is Florian, thank you for joining me today. But before we get into the details of this, we first need to understand what exactly drives this market. It's important to remember that even if a company is active in this space, it doesn't necessarily mean it's staying on top of the latest trends. And keeping up with the latest trends is not just a recommendation, but a necessity for their survival in this fast-moving industry. The WEF, the World Economic Forum, did a survey with 321 CEOs and CISOs, the Chief Information Security Officers, and additional 43 in-depth one-on-one interviews. And in this research, they found that CISOs see a complete disruption of the company's operation as the biggest risks. 45%, so almost half of the people that are responsible for security in their companies, state this as their largest concern. In case of CEOs, their major concern for 33% of them is the loss of sensitive information or theft of their intellectual property. These two topics are by far the most important ones and are followed by the fear of financial loss and the loss of their brand's reputation and customer trusts on the places 3 and 4. I also find it pretty interesting and telling that only 13% of these top managers that are all active in medium to large organizations think that their cyber resilience is up to the requirements. 77% of them only believe that it meets the absolute minimum requirements, while further 10% think that they don't even meet these minimum standards. And in the public sector, this is even worse by far. One reason for this is the huge skill gap in cybersecurity skills, but also AI skills. 39% of the participants of the survey stated that skill shortages are one of the most important barriers they have to overcome. According to estimations, there is currently a shortage of 2.8 to 4.8 million cybersecurity professionals. So the right talents are very rare, which means that a cybersecurity company that can attract skilled people has a large advantage here. And just to show you that this is easier said than done, this is the matrix of the cybersecurity control assessment from Gartner that is aligned with the industry-wide frameworks and standards. It includes so many different areas and skill sets that I get sick just by looking at it and trying to grasp the implications. And we are also here to find a good investment, not to understand the intricate inner workings of the cybersecurity industry. So instead, let's rather have a look at the top trends in this market that SentinelOne, a cybersecurity themselves, identified for this year. The biggest trend of the year is AI-driven malware, where criminals use machine learning to evolve their code in real time. Then we have zero trust architecture, where the continuous authentication of users becomes more and more important. In the company I work for, we just implemented this by the beginning of the year. Now, I spend more time confirming that it's really me than I spend with real work, which is pretty annoying, to be honest. The list goes on, but again, my point here is that this is a very complex and diverse field that is changing constantly. It also doesn't help that the risks are different for different industries. And to avoid massive financial and reputational damage, organizations need to keep up with the latest trends and sometimes, as is the case for quantum computing, also take new and emerging technologies into account that are not even ready for the mass market yet. So, between the skill requirements of the people who work in this field to the constantly changing trends and technologies, to me, who is not a cybersecurity expert, even though I finished an apprenticeship as IT specialist before I studied physics, this is a pretty intransparent and quickly moving industry. And as an investor, this is exactly what I'm trying to avoid. And I've not even started on the different segments like hardware or software here. When you're watching this, you probably know what Warren Buffett said about investing in things you don't understand. To put it short, don't do it. I've played MOBAs for long enough to know the Dunning-Kruger effect, and I know that I probably know less about these things than I actually think I do. Shout out to everyone who still plays Heroes of the Storm, by the way. I could still approach this from a purely financial point of view and compare the fundamentals that I either way check for all of my investments. But then, I need to be on top of things even more than I already try to be with the companies I own. And I'm afraid that this would mean that I need to switch my investments on a regular basis. And I'm a long-term investor. I choose my investments with a time horizon of 5 to 10 years. So this is something with which you could achieve a better performance, but something that I'm just not willing to do, especially if I don't understand the sector well enough. So what other options are there if you don't want to guess who the winner in the sector will be, but still want to benefit from this megatrend? Well, the answer is of course to buy the whole sector. And the easiest way to do this is with an ETF. And there are actually a couple of cybersecurity ETFs out there that are based on different indices from which you could choose. I own shares of the iShares Digital Security ETF in my portfolio. And as of this recording, this position is worth 6,900 euros and is up by 46% from my average entry price. I actually didn't buy everything at once, but I built this position over the course of 6 months. I started buying into it in November 2022 and then increased my position a couple of times until it reached my target size in May 2023, almost exactly 2 years ago. This is usually how I approach my investments. I just invest all the money that I have to spare each month, besides my emergency fund that I always keep, of course. So I'm usually building up these positions over the course of several months. When we go to TradingView and look at the chart of the index, this time where I bought into it was right at the tail end of the bear market in 2022. In hindsight, a very good and, let's be honest, lucky time to enter. But I am not here to brag. I am making this video because I think it will be interesting to hear my thought process behind my choice of this particular ETF. And while we're at it, let's also see how other cybersecurity ETFs performed during this time to see if any of them actually outperformed the one that I choose. To compare ETFs, I like to use just ETF because they have a lot of data and you can sort, select and compare many different metrics. To get this particular list, I have screened for cybersecurity ETFs that only include stocks. And to better compare them, I selected the columns fund size, TER, the total expense ratio, the distribution method, the number of holdings, and the 3-year and 5-year performance. I've also included the ticker symbol and the ISN here for you to quickly and easily find these ETFs if you're interested in them. And what I look for mostly when selecting such themed ETFs, or any ETF for that matter, is first of all, the total expense ratio. Because the costs will have an immediate and direct impact on your overall returns and are also something that you can directly control in contrast to the performance. So the lower the TER, the better. And in the case of our ETFs here, the TER ranges from 0.35 to 0.69% per year. This doesn't sound like a lot, but if you're like me and plan to hold this ETF for at least a decade, if not longer, this will add up very quickly. To put this into context, if we invest, let's say, 10,000 euros or dollars or apples for 10 years, and we assume that the ETF will produce 10% returns over this time, which is roughly in line with the average long-term returns of the S&P, we have to subtract the yearly TER from this return. In the case of a TER of 0.35%, that leaves us with a yearly performance of 9.65%. And after 10 years, our 10,000 euros would have grown to 25,124. If we assume a TER of 0.69% on the other hand, this would leave us with annual returns of 9.31%, which after 10 years gives us 24,355 euros. That's a difference of 768 euros. That doesn't sound like a lot, but it's still around 8% of our initial investment that you are guaranteed to get by only looking at the TER. And the longer we stay invested, the bigger this difference will get, thanks to the compounded interests. The second important metric for me is the fund size. I like to use ETFs that have a size of at least 500 million. A bigger ETF can be managed more cost effectively, which sometimes, but not always, has an effect on the TER. And even more importantly, smaller ETFs always run the risk of being unprofitable for their providers, which might lead to them being liquidated. That doesn't mean that you will lose all your money, but you might be forced to sell your shares at an inconvenient time. So in the worst case, you'll run the risk at selling your shares at a loss, and even in the best case, you will still be forced to sell your positions and pay taxes on them, which again hinders your compounding process. So in the case of our selection, the biggest ETF is the LNG cybersecurity ETF and the iShares digital security ETF. The First Trust Nasdaq cybersecurity ETF is also still well within my acceptable size range. And all three of these ETFs are also accumulating, which I also prefer. But this is just my personal preference. If you prefer a distributing ETF, that is also fine. In this case, you'll get the dividends paid out in cash instead of them being reinvested automatically. So with these metrics taken into account, I had the choice of 3 ETFs. And from these 3, the iShares is the one with the lowest TER by far. So for me, it's the most obvious choice. But it is also the one with the most holdings, with over 100 compared to around 30 for the LNG and the Nasdaq one. And this is a bit of a double-edged sword, because the good thing with many holding is that it's diversified. On the other hand, the bad thing is that it's, well, diversified. Usually, you'll want to diversify to lower the risks. But that only works if you spread your holdings over different countries, company sizes and markets. So in case of such specialty ETF that are targeting a designated sector, I don't think that it makes as much sense as for a broad market ETF like the MSCI World or the FTSE All World. In the end, you are buying it because you want to increase your exposure to a certain market. In this case, I think that 100 holdings are still okay, but I wouldn't want to go much higher. So when I'm at this stage, the last thing I do is to narrow down my selection and then directly compare the ones on my shortlist. What I am looking for here are mainly the top 10 holdings and the country and sector exposure. In the case of my iShares, it is the one where the top 10 holdings have the lowest weight with a bit over 20% compared to 55 or 60% of the other two, and the exposure to US is also the lowest one. I wouldn't give too much on what the top 10 holdings are exactly, because this will change depending on which companies perform well according to their selection criteria. So this will change over time. I also find it interesting to look at the risk-return chart in different time frames. Here we can see that a larger diversification does indeed lower the volatility, but also the overall returns of the iShares compared to the other 2 ETFs. For completeness sake, I also want to mention that you have the links to all the fact sheets and documents for all these ETFs here. I do indeed check these fact sheets, but honestly, you can find basically all information that is in there here on this detailed comparison page. So this isn't strictly necessary, just something for people like me who don't know when to stop. And speaking of stopping, the last thing to do is to compare the performance of these 3 ETFs since I bought them. But before we do this, if you like the video so far, it would be amazing if you like the video now and subscribe to the channel to not miss my next one. As a thank you, I promise you to read all of your comments and to reply to pretty much all of them. But back to the comparison. There is a comparison tool built into Just ETF, but for some reason it does not want to apply my custom range. So instead, let's jump into TradingView and compare them here. As a time frame, I just used the beginning of 2023 here because I owned around half of my position then. Since then, my ETF actually had the worst performance of these 3. We also see that the LNG index in pink had by far the highest volatility, so in this case, the performance depends a lot on the exact time frame. But the Nasdaq index looks great here with quite stable returns that are also ahead of the other 2 indices for the majority of the time. So this one might have been the better idea. But when I started my investment, this ETF was not even 2 years old and well below my acceptable fund size. So I didn't even have it on my list back then. And as we saw, the costs are also quite a bit higher. It is also the one with the highest concentration on their top 10 holdings and the highest concentration in US companies, which could explain the performance difference. But as I said, in case of such specialty ETFs, this concentration is not bad per se and might even be what you're looking for. For me, it was actually the first time since I bought this ETF that I compared its performance to others from the sector. So now I need to decide if I still want to keep the one I already have or maybe switch it to the Nasdaq one. Of course, I will keep you updated on what I'll do in my regular portfolio updates. But this is just my opinion. How do you choose your ETFs? Do you have a similar thought process or do you find them in another way? And which of the 3 candidates do you like most? I'd be really interested to hear your thoughts down in the comments below. And guys, I am trying to be fully transparent about my investments and my investment strategy here on this channel. That is why I share and update my portfolio on a regular basis. If this sounds interesting to you, be sure to check out my latest update right here. And this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.